big benefit, of course, is you've got capital allowances. Section 24 doesn't affect you, especially if you hold the properties in your own name or in a partnership or an LLP. I am going to come on to LLPs in a few moments, but obviously Section 24 doesn't apply if you own properties in a limited company anyhow. But that's a benefit. On top of that, you can. So I bought a commercial property about 3 years ago, 2.5–3 years ago, and unfortunately on that particular property we had to apply for planning to convert it into flats. So the purchase price was £500,000. The planning and the legals and the SDLT and all that rigmarole, which has, and I think Colin's right when he said that planning officers are overworked, underpaid, too much stuff on their desk, and planning applications always take so long. I mean, I'm working on one right now in Boston, and we should have had it over the line, and I don't think we're going to be anywhere near the line before Christmas. The one before that I was working on in Grantham for 100 houses. Took 3 years. 3 years for them to come back and say, no, you can't have the planning. Anyhow, this particular one took about 9 months. So bought it for £500,000, 65,000 for the planning, the legals, all of that, and the cost to refurbish it is £400,000. We paid cash to buy the property, and we've financed the development costs. So all in all, and forgive me for throwing numbers at you, I prefer not to use slides because I'd rather have a conversation. So Rupert, if anybody has any questions, feel free to stop me and ask the question. I'm more than happy to answer them. So you'll have to trust me when I say that the build cost or the development cost plus all of the costs equated to just over £1 million, 1,017,000, and the end GDV value was 1.32 million, plus we've got a 2-bedroom bungalow on top that's worth 150,000. So we're near the 1.5 million mark. But let's leave the bungalow to the side. The profit on this particular deal was just over £300,000, so £302,000. What we did was we bought it as a partnership, and one of the first things I'll bring to people's attention, I know Sue's on this call here, so she may wish to contribute, is when you're buying commercial property, you might have to pay VAT on it if the previous person or one of the previous owners has opted to tax. What that basically means is at some point in the past, usually they wanted to carry out major refurbishment work to the property and wanted to get the VAT back. So HMRC, as nice as they are, say of course you can have the VAT back, but there's two things you have to do. One is charge VAT on the rent going forward, and the second is when you sell the property, you've got to charge VAT on the disposal. So if you're looking to do a commercial conversion and you're having to pay VAT, one of the options available to you, subject to the vendor agreeing, is you can file a VAT 1614D, which basically says you're going to convert the property to commercial, from commercial to residential, and that's going to save you on paying the VAT. It's going to save you on the SDLT, because the stamp duty land tax is paid on the purchase price plus the VAT on top. And that's obviously extra stamp duty land tax, because SDLT works in different tiers. On top of that, you then don't have to raise funds for the VAT element. You then don't have to file VAT returns to try and get the VAT back. That can take 3 months, and I've seen it take 9 months. Because HMRC, as nice as they are, they like collecting money, they don't like refunding money as much. So do consider the VAT 1614D. After having purchased it, one of the first things that we did was claim capital allowances. Now the capital allowances claim on this particular building, which we paid £500,000 for, came to just over £126,000. So in percentage terms, although I don't like to see capital allowances quoted in percentage terms, where just over 25% of the building cost was attributable to capital allowances, which I'll come on to in a second. So after having bought the property, we've got the capital allowances claim. We were very clear that we were going to move this particular business into a limited company, and we were also very clear that we were going to run serviced accommodation once we've converted it. So after having obtained the planning, you can imagine there's going to be an uplift in the value of the property or the asset. If you then move that asset from a partnership business, and it doesn't have to be a partnership as such, but if you move it from a partnership business into a limited company, you'll get an uplift in the base cost because the value of the property has gone up. And in very simple terms, without complicating it and without making it too technical, what that means is at some point in the future, when we look to sell that property or part of that property through the limited company, we're going to reduce our capital gain. Now, of course, companies don't pay capital gains tax, they pay corporation tax, but they still make a capital gain on the value of the asset. So in our example, we bought it for £500,000. Having obtained planning, it was worth £650,000. So when it moves into the limited company, there's that £150,000 uplift that we get, which we wouldn't get if we sold it through the partnership. Some of the kind of key reliefs that we claimed before I get onto serviced accommodation, which helped us a lot. The first one was there was a significant amount of asbestos in the property, so we had that cleared, and by having done so, we were able to claim land remediation relief at 150%. So that gave us an additional, just over £14,000 in additional relief. Something else which we did, which worked really well, it is like a tax, and I think sometimes some people don't see it as a tax. I was working on a different development again in Boston. So on this particular property, it was empty. We were having to pay business rates, and I got talking to a local charity, and they work with homeless people, and they wanted to use the premises to create some opportunities for homeless people to go in there, have a cup of tea, someone to talk to. So I gifted them use. When I say obviously I had other business partners because it's a partnership, but we gifted use of the property to the charity, and what that meant was they were liable for the business rates. Now usually charities get an 80% discount on business rates. They can apply for the additional 20% discretionary rates relief, which they did, and they obtained that. So that saved us just over £10,000 in business rates, which again, as I've said, is a tax. On incorporation, you'll recall I said from the uplift was from £500,000 to £650,000. So that additional £150,000 saved us. It's going to save us tax at some point in the future if the corporation tax rate stays at 19%. That's going to save us £28,500. The physical saving on the capital allowances, as in the tax saving on the £126,000 worth of capital allowances, that's going to save us £23,964 in tax, which is pretty sizable. The saving on the STLT in terms of the VAT was £7,500. So you can see as you start adding up all of these numbers, it's well over £100,000 that we were able to save just by using certain tax allowances in a pretty smart way. Now, of course, if you're looking to do a refurb from commercial to residential, you'll then pay 5% VAT on the refurb and not 20%. However, if you decide to buy all of the materials yourself, then you'll be paying 20% VAT on the material. So the best thing to do is to subcontract the whole lot to a contractor, so they buy the materials and the labor and only charge you 5% VAT on the whole lot. So the uplift in profit was from £302,000 all the way up to £417,000. So we were able to increase our profit by best part of £112,000 by using different tax reliefs and allowances, and I think you should seriously consider those. Now what we've done is, obviously the property ends up in a limited company. We run that as serviced accommodation. We now get a second bite at the cherry. Again, I'm sure Richard Heyer will cover this during his talk. But because we've refurbished the property, we can now claim additional capital allowances on all the new fixtures and fittings that we have in the building. So that gives us even more to claim. And there's something called the annual investment allowance, which at the moment is at £1 million, which means you can write off £1 million worth of expenditure in one go. That's going to finish at the end of this calendar year. Then it's going to go back to £200,000 unless the government decide to change the rules. So you can very quickly accelerate your allowances. And how that would work, as a very simple example, is, let's say I made £200,000 worth of profit in the first year, and let's say I've got £200,000 worth of new capital allowances. I can write off those £200,000 worth of new capital allowances in the first year, thereby paying no corporation tax whatsoever. So it is pretty powerful. Something which you need to be aware of, which won't apply especially if you're holding on to the serviced accommodation units, is obviously if you sell those units, you might have a balancing charge to pay. But again, we're not going to get into the complications of how tax works. Once I'm running those serviced accommodation units, as long as they are meeting the rules of being a serviced accommodation unit, the big benefit, of course, is you've got capital allowances. Section 24 doesn't affect you, especially if you hold the properties in your own name or in a partnership or an LLP. I am going to come on to LLPs in a few moments, but obviously Section 24 doesn't apply if you own properties in a limited company anyhow. But that's a benefit. On top of that, you can make pension contributions. So going back to my earlier example of where if you've got £200,000 in profit, you can write it up against your capital allowances. Let's now say you've made £240,000 or £250,000 of profit. You write off the £200,000 against the capital allowances. You've got £50,000 remaining, on which you'll have to pay 19% corporation tax. If you want to make a pension contribution, you could do up to £40,000 per person, and if you haven't made any contributions in the last 3 years, as long as you were part of a pension plan, you've carried those forward, you can use some of your unused allowance. So you can very quickly see how this is now building up to making quite significant tax savings by using capital allowances, some of the other tax reliefs, plus pensions. But I'm not going to go into pensions in detail because A, I'm not a financial advisor, and B, it's outside the remit and the scope.